Welcome into the Invest Well Show, everybody. As always, I'm your host, Michael Wall. I want to talk this show about something that I think is going to be crucial for you, and that is kind of identifying the different ways that you can enter into a real estate investment. Now, there's a lot of different ways that you can invest in real estate. I mean, you could start out and just say, hey, I have extra money, and I'd like to go buy a home, and maybe you want to Airbnb that home, or maybe you flip a home, and you are in a place where you add some money, and you refurb, and you sell it, right? Borrow money to kind of do what you need to do and then sell the home, make a profit. And then there's larger deals that are kind of like LP opportunities where you can get in direct as a limited partner. And then there's also other opportunities where you can invest in as a REIT, real estate investment trust. And those are the two that I want to kind of talk about and identify on this show. What is really the difference, the pros and the cons between a direct investment LP-GP model, okay, and also a REIT, publicly and non-publicly traded, because there's benefits and disadvantages to both. Now, one of the things that's so interesting is in our society today, with social media today, there is so much information out there about, hey, buy this course about how to buy this property in real estate, no money down, or you should invest in this big, large fund. We've been doing all these things for some time, and it can get a little bit convoluted to know exactly what should I invest in. Now, I've found over the years, many of you know that we have several other companies that actually have helped families with their wealth. By the way, you got questions about that, head over to leanonthewall.com. But help families with their wealth in many different capacities. And investing in real estate, I believe, is a staple to building a quality portfolio over time. But many folks are just in a place where they don't want to directly themselves be identifying properties, identifying how to bring all the details together, ensuring that they're buying quality real estate, making sure that their investments aren't over-concentrated in a particular location, and buying it incorrectly. So oftentimes, buying in through a direct real estate deal like a GP-LP model or a REIT, publicly or non-publicly traded, often offers great opportunities. So when we take a look at this, let's talk about the reality of what are some of the pros and cons, and let's break this down. Let's start with direct real estate, all right? So before we get into the pros, we got the GP/LP model. Obviously, the GP is the general partner. This is the one that's kind of managing the deal, making the decisions on the deal, ensuring that the deal is doing what it's supposed to do as written out in the PPMs. And then you have the LP, which is limited partners, though these are often investors that want to be part of the deal. Obviously, there's some benefits to doing that. The benefit to the LP is they don't have to take care of the day-to-day details, but there's also some other pros that come alongside. So let's jump into some of the pros of direct real estate investment itself. All right, so some pros here listed on the screen. You'll see you get control of asset selection, location, and type of real estate. You got targeted investments, no blind pull investments. Let me just pause on that real quick because you may say, well, what is a blind pull investment? Over the years of being in the investment space, almost 25 now, it's crazy to think about. One of the things I've seen over the years with a lot of larger deals in the past, they oftentimes were blind pull investments. A blind pull investment is the idea where there's money coming into the deal. So someone decides they want to invest in, let's say, multifamily because they believe multifamily properties, that's a property where multiple people live. Maybe there's 80 or 90 apartments or 100 apartments. That would be considered a multifamily unit. So let's say a group wanted to invest in multifamily in different parts of the country. Let's say they wanted to invest in Florida and in Georgia and in Tennessee and in South Carolina. But they did not have specific investments identified. In other words, they just said, hey, we know we want to invest in multifamily. We know it's a good opportunity. We believe it's going to bring a nice return for our investors, but we don't really have any investments, quote, in the pipeline. In other words, there's nothing they've researched. There's no properties they've looked at to build on. There's no geographical and demographic studies that they've done to kind of really understand this is probably a good area to build. They're not in a situation where they've done the legwork to really say, okay, when we raise the money, we're going to specifically have a place to put the money to work. It's almost like saying, I want to buy a car, but I really don't know what kind of car I want to buy. And so you raise money from people to go buy your car, and then you shop for a while to buy your car. That's the idea of a blind pull investments. The challenge with that is the monies in a blind pull is kind of sitting idle while the folks are looking for opportunities to purchase, which drags down your overall investment return. If you can imagine, if you had money sitting there idle for 2 months or 3 months or 4 months or 6 months or longer, well, that money's not making any money. It's just sitting there waiting for an investment project for it to be deployed to. So let's go back to the pros. So when you take a look at that with the direct real estate investments, as I mentioned, you can target investments and there are no blind pull investments. That's really important. Number 3, there's income potential for higher returns due to direct ownership. Also tax benefits via depreciation, pass-through deductions, cost segregation, etc. And there's no market volatility. Now, these are all really important. When you take a look at some of these things, when you look at cost segregation, when you look at pass-through deductions and some of these things, these are all available through direct real estate, the LPGP type model. Obviously, depending on the deal, depending on what they invest in, is going to depend on how much benefits you get. The benefit of pass-through deductions and cost seg really flows out to you, the investor, in a way that you're actually going to have some tax savings. That's the benefit. So one of the great benefits overall with real estate as time has passed is, in time in the future thus far, with the way the rules and regulations are and legislation is there can be a lot of benefits tax-wise to you when you invest in real estate. So as an example, if you invest $1 million in a piece of property, based on the type of real estate you invest in, you might be able to participate in cost segregation, depreciation, and a variety of other things based on the type of deal. And it allows you the ability to actually deduct on your taxes a lot of what you invested. So you might invest $1 million. You might be able to deduct $700,000 or $800,000 of that million on your taxes, even though you invested it. It's quite a great benefit. Now, there are some cons to direct real estate. So let's jump into those. Some cons of direct real estate are this. You got illiquid, and it typically requires longer commitment. And that's really why it's important to look at funds that are going to be at a 4 to 6 year cycle. Diversification is another con. In other words, some funds may lack diversification if they're concentrated in a particular area. That's super important. So you want to make sure that when you invest in a direct deal, you want to know, is it one property? Is it multiple properties? And it doesn't mean that it's negative or bad to invest in one property as long as the research has been done and you feel good about that. And obviously the old adage of not putting all of your eggs in one basket. So you want to make sure that you have different types of properties in different locations that you're investing in. This will give you the ability to kind of stay away from concentration risk. Imagine if you were going to go out and buy a bunch of Chick-fil-A's. I don't know if you like Chick-fil-A's or not. You know, the old signs, eat more chicken. Okay. You're going to go out and buy Chick-fil-A's and you like a Chick-fil-A, but you don't necessarily know where you want to buy. So you decide, I'm going to go invest in Chick-fil-A, and it's in one particular location. Well, the benefit of that is you're invested in a Chick-fil-A and you're going to participate in the profits. The disadvantage of that is you are limited to the profits of the Chick-fil-A in that particular location. Maybe there's some type of natural disaster that occurs, and that causes you to have to close doors in that Chick-fil-A. Maybe there's other challenges where people are moving out of the area or whatever else it may be. And so you're limited to just the profit in that Chick-fil-A. However, if you decided, you know what, I like Chick-fil-A, I like the model, and instead of investing into one, I'm going to invest in 6. I'm going to invest in 6 different Chick-fil-A's in different locations in different areas. That way you can kind of hedge your bets a little bit. So that way if one area is in a place where maybe one property is underperforming, the other properties will kind of lift it up, if that makes sense. It's the idea of diversification. And so it's the same way with direct deals. You want to make sure that you're not just invested in one property, and that's okay, but make sure you're invested in multiple properties through multiple deals, which diversifies your risk through your investment stack. All right, let's talk about the idea of REITs. Now, REITs have been around for some time as well. There's publicly traded REITs and non-publicly traded REITs, often known as publicly traded REITs, which is actually a stock that's on the market. It's an actual equity that you can buy in the market. Now, there's some benefits to that. Obviously, you can buy in today and sell out tomorrow, but there's also some disadvantages, which is you're sometimes ebbing and flowing with markets up and down. And then you have non-traded REITs, which, as they sound, are not publicly traded. These are important. So let's look at some of the pros of REITs. All right, here we go. So there's increased liquidity. I talked about that before. If it's publicly traded, you can sell out immediately the next day, T+3 with a stock. There's lower minimum investment, access for retail investors, and then there's diversified in many locations, oftentimes, and many different types of real estate, oftentimes, and that can be a benefit sometimes. So let's talk about the idea of retail investors. So with REITs, oftentimes, these are things that are offered to retail investors. What's a retail investor? Well, it's someone that is not accredited. An accredited investor has to maintain a certain amount of income. Typically, it's a couple $100,000 a year or more for a couple years at a time, or they have to have a certain amount of investable assets besides the value of their home. Typically, 1 to 1.2 or a couple $1 million or more they need to have in order to invest in a deal. That's an accredited investor. With REITs, you do not have to be accredited. And so you're in a place where with most REITs, it's just retail investor, which means you can have a lower investable amount. So if you're in a place where you don't have as much money, maybe you don't have as much wealth, that might be a place to start. But if you have more wealth, oftentimes what I've seen over the years is direct deals, the first thing that we talked about, can often be more advantageous because of the opportunity, the upside opportunity to invest in it. Obviously, with anything else, the more opportunity, the more risk. But as long as you quantify the risk and as long as you look at what is the risk that I'm taking and how does it affect me, those are the key points that matter. Let's talk about the cons, though, the negatives, if you will, of REITs themselves. All right, so let's take a look at this. So first off, they're often larger. They're larger assets under management. There are management fees as well that allow the REIT to operate with no urgency to liquidate assets. Now, I just want to press pause on this because when you take a look at this, this is so important. When you look at an investment in real estate, oftentimes there's two ways to think about it. You've heard of the concept before of mailbox money. Like, I just want to buy real estate to have a bunch of mailbox money, which means you're going to manage it, you're going to keep it, you're going to rent it, etc. And that's fine. But where most investors make a larger percentage of their, we'll call it profits on real estate is when they sell. Remember the old adage, know when to hold them and know when to fold them, right? So when they sell is when oftentimes more money's made on real estate. And that's why direct deals can be sometimes more appealing. But on REITs specifically, they have management fees, and there's really no incentive for the manager to get out. I mean, imagine paying a manager 1.5% to 2% a year to just manage the REIT. And the manager knows that if we sell this REIT or we get out of the offering, that management fee goes away. They're kind of cutting their income off. That's one of the things that I personally do not like about REITs themselves. All right, let's go back to the cons. So obviously we have the management fees. We have a long investment horizon to exit or sell the assets, obviously due to the size of the REIT. Oftentimes there can be over-diversification, little or no tax benefits, market volatility, and no control over investment allocation. So when you look at all of these things, it's the idea of really you have to start at the beginning and saying, okay, where are you in your investment stack? In other words, if you're an accredited investor, $1 million plus, $1.2 million plus, if you have that kind of asset or more, or you're making a couple $100,000 a year or more, now you're in a place where you have the opportunity to go to more direct investments. If you're not an accredited investor, then you're going to be in a place where there might be sometimes still some stipulations on the amount of assets or income you need to get into some REITs. So it's not a blanket statement. Be aware of that. But you're in a place where you're going to have the opportunity to join into REITs as an opportunity. So when you boil it all down, what are some of the thoughts that I have? Now, obviously, this is not advice. I want to challenge you to, when you want to look at getting advice on your specific situation, make sure you're talking to somebody that understands this world well and they really have your best interest at heart. My opinion, however, in taking a look at these types of investments are, I believe over the years, the math as far as the profit can lean heavily towards direct investments as far as the opportunity for you, the investor, to make more over time. There's several reasons why that's the case. One is because you're more directionally focused and you can oftentimes make more money on a particular asset. Two, you're in a place where you get to include a lot of the tax benefits along the way. You're going to get K-1s instead of 1099s, which is what REITs kick. So you're in a place where you're going to get more opportunity to participate in tax benefits in different ways along the way. Ultimately, that adds to your bottom line is what you're overall essentially able to earn. And the other thing is the periods of time I've found are often not as long, and the general partners on direct investments, direct real estate, are typically more incentivized to get out. So you want to make sure that when you're getting into a real estate deal, you're looking at the structure as far as how do the general partners make most of their money, or they call it oftentimes the waterfall. How do they make their money? And oftentimes they make the bulk of their money when they sell the real estate. It's your best interest in a lot of ways that if they make most of their money when they get out, you're in a place where you can feel a little bit more confident in the fact that they're going to want to sell earlier rather than later. That's a good thing because now you've sold, you've made your money, you take that money, you redeploy it into other investments, and you continue the cycle. But I hope that was helpful in relation to some of the different types of real estate, the direct real estate versus the REITs. And I wanted to take a few minutes and just kind of articulate some of the details around these. If you got questions about your personal situation and what you should be doing, I want to challenge you to reach out to the sponsors of this show. They work with families with several $1 million or more. LeanOnTheWall.com is how you can connect with them. Great team of folks that have been helping families not only grow their wealth, but save money in taxes over the years. And it'll help you at least get a little bit of an idea of what potentially might be best for you. Be blessed. Stay well. Talk to you next show.